I think that there is a possibility that Buffett's right, that gold is a pet rock. I think that there is a stronger possibility that for most people, Buffett is wrong. Buffett points out that gold doesn't produce anything. It isn't intended to. It's insurance, and insurance doesn't produce anything either. If you are Buffett, if you are capable over decades of generating real economic returns that exceed your needs and exceed the market, if you are capable of understanding investments that keep pace with and exceed inflation, you don't need gold. Sadly, after 50 years, I've come to learn that I am not Buffett. And while he doesn't need that insurance, I in fact do. So I think part of the equation revolves around who you are and what your needs are. As we discussed at the top of the show, gold has done well during periods of time when individuals are concerned about the maintenance of their purchasing power in conventional savings instruments. And I believe that people are right currently to be concerned that negative real interest rates, which exist around the world, are a mechanism of plundering savers on behalf of spenders. And those programs are extremely popular, ironically, even among savers. If you look at debt and deficits, what debt and deficits do is they constrain the credit capabilities of the societies that borrow, which is to say they increase the risk of default, at the same time that the compensation for that risk is negative as a consequence of negative real interest rates. The reason, and this has gone on for some time, the reason I think that gold investments are more timely has been the fact that we've been through 40 years of very benign economic climb. And we have been able to A, lower interest rates while B, affording our stupidity over 40 years. My suspicion is that the tides are changing. What this means is, I think, that you're going to have fairly massive disintermediation. That's a fancy way of saying selling in the long bond, and that money is going to be redistributed to other asset classes. It isn't all going to flow into gold, but I suspect if the new concern is around inflation, the same way it was in the 1970s, that some of that money is going to flow into an asset that has a historical reputation for providing safety in just that set of circumstances. And that's why I think the market share of gold is so important. As you described, JP Morgan Chase has said that the market share of precious metals and precious metals related assets in the United States is 0.5%. I'm not suggesting that gold is going to win the war against the long bond, or gold is going to win the war against US treasuries. I'm suggesting that demand for gold, because of negative real interest rates, because of debt and deficits, is going to revert to its statistical mean, which is to say 2% market share. If that occurs, demand for precious metals quadruples. And that's precisely what I think is going to happen, and precisely why. If inflation isn't accompanied by higher interest rates, or even sometimes when it does, is wonderful for the price of precious metals. Gold classically does well when people are concerned about the maintenance of purchasing power in other forms of savings and investment assets. Inflation in the fashion that we're seeing now, in a period of persistently low interest rates, although not as low as they used to be, drives those concerns. If you look at the economics as an example of the US 10-year Treasury, the primary savings instrument in the world, sorry for the American-centric comment, but it's true, the arithmetic that would attract people to gold is very evident. In the US 10-year Treasury, the US government promises to pay you 3.75% or something like that every year for 10 years, in a currency that the Congressional Budget Office suggests is declining in terms of purchasing power by 7.5% a year. So you take the 3.75 that they propose to pay you, and you subtract 7.5. What you see is that the U.S. government is solemnly promising to reduce your purchasing power by almost 4% a year compounded for 10 years. My friend Jim Grant calls this return-free risk. I would suggest to you, first of all, that this is the first promise that my government has made me in my 70 years on Earth that I'm confident that they will keep. And it tells me, too, that it is likely that gold can win a war against return-free risk. It tells me that the nervousness that savers might have around the efficacy of an investment that promises to cost them 4% of their purchasing power compounded over 10 years is probably a challenge that gold is up to over time. So I hope that's helped discuss the interplay between commodities, investments, precious metals, and the economy at large. Particularly, I think, the political economy. If your listeners believe, that there's going to be a synchronized global recession or depression, they probably need to emphasize industrial materials and commodities less. If your listeners believe that governments around the world are going to allow interest rates to rise to free market levels or constrain their spending, their quantitative easing — by the way, quantitative easing is government speak for counterfeiting — or control their spending, I think they probably should ignore investments in gold and silver. Particularly with regards to the latter set of circumstances, governments controlling their spending, governments allowing interest rates to rise to free market levels, or the resumption of positive real interest rates. I don't believe any of those things will occur. But if I did, I would shift all of my emphasis to conventional banking and insurance investments, and I would forget about natural resources and precious metals. I would suggest that the central bankers are buying gold not so much for the reason that I would buy it, but because they understand the dilemma that they themselves face, and they suggest that other central bankers are facing the same dilemma. If you are an American central bank, the idea that you're attracted to Eurozone securities or Japanese securities or Chinese securities is of low interest to you. The second reason, I think, is the weaponization of the U.S. dollar. I would suspect that the greatest enemy that the U.S. dollar has is Congress. The idea that they've tried to impose extraterritorially the political preference of the United States on countries like China, Russia, Saudi Arabia, Mexico, India, countries, Saudi Arabia, that have their own preferences, means that we have literally driven those central banks out of the SWIFT banking system, out of a reliance on the U.S. dollar, which is still the most liquid and transparent medium of exchange on the planet. In other words, the franchise around the U.S. dollar is something that the U.S. is actively destroying. And the greatest promoter of asset classes other than U.S. dollars and U.S. Treasury securities among central banks, ironically, the greatest promoter of disintermediation around the U.S. dollar is, in fact, U.S. Congress. I think this weaponization is particularly important. The idea that the U.S. decided to weaponize the SWIFT banking system has meant that countries that wanted to pursue their own agendas and trade with each other have chosen, frankly, reluctantly, to abandon the dollar standard, in fact, in favor of other bilateral or multilateral standards. If I might answer the question for a little while longer, in my prior employment, working for Sprott, selling Sprott investment products to some of the largest sovereign wealth funds in the world, I remember having the occasion to ask at least 3 sovereign wealth fund managers why they had such large concentrations of U.S. Treasury securities in their portfolios. I described the U.S. dollar relative to debt and deficits as perhaps a lie, particularly with regards to negative interest rates. And I will never forget one of my counterparties looking at me, smiling and saying, "Rick, of course what you say is true, but the dollar is the deepest and most liquid lie that we know." I said point blank, "Do you trust us?" He said, "Of course not, but we trust you much more than we trust each other."